Exchange-traded funds, ETFs, have become a popular investment vehicle due to their versatility and cost-effectiveness. Here's a comprehensive look at what ETFs are, how they work, and why they might be a valuable addition to your investment portfolio. What are ETFs? Definition: an ETF is a type of investment fund that is traded on stock exchanges, similar to individual stocks. It holds a collection of assets, such as stocks, bonds, or commodities, and its price fluctuates throughout the trading day based on the value of the underlying assets. Structure: ETFs are designed to track the performance of a specific index, sector, commodity, or asset class. For example, an ETF might track the S&P 500, providing investors with exposure to the 500 largest publicly traded companies in the US. How ETFs work: creation and redemption. ETFs are created and redeemed through a process involving institutional investors known as authorized participants, APs. APs can create new ETF shares by delivering a basket of the underlying securities to the fund manager, or redeem shares by returning them to the fund in exchange for the underlying securities. Trading: ETFs are bought and sold on stock exchanges throughout the trading day, just like individual stocks. The trading price of an ETF reflects the net asset value, NAV, of the underlying securities, adjusted for supply and demand. Expense ratios: ETFs typically have lower expense ratios compared to mutual funds. The expense ratio represents the annual fees expressed as a percentage of the fund's average assets under management. Lower expense ratios mean more of your investment returns stay in your pocket. Types of ETFs: stock ETFs. These ETFs invest primarily in stocks and are designed to track specific indices or sectors. Examples include broad market ETFs, sector-specific ETFs, and international ETFs. Bond ETFs. These ETFs invest in fixed income securities like government or corporate bonds. They provide investors with exposure to a diversified portfolio of bonds and can offer regular income through interest payments. Commodity ETFs. Commodity ETFs invest in physical commodities or commodity futures contracts. They allow investors to gain exposure to commodities such as gold, oil, or agricultural products without having to directly purchase the physical assets. Sector and industry ETFs. These ETFs focus on specific sectors or industries, such as technology, healthcare, or energy. They provide targeted exposure to particular areas of the economy and can be used to capitalize on sector-specific trends. International ETFs. International ETFs invest in assets located outside of your home country. They offer diversification across global markets and can include developed or emerging market exposure. Advantages of investing in ETFs: diversification. ETFs provide instant diversification by holding a basket of securities. This reduces individual stock risk and helps spread your investment across multiple assets. Liquidity. ETFs are highly liquid due to their trading on major stock exchanges. You can buy or sell ETF shares at any time during market hours, and their prices are updated in real time. Transparency. Most ETFs disclose their holdings on a daily basis, allowing investors to see exactly what assets they own. This transparency helps investors understand the fund's exposure and risk. Flexibility. ETFs offer flexibility in terms of investment strategies. You can use them to gain exposure to specific sectors, hedge against market fluctuations, or implement various trading strategies. Considerations when investing in ETFs: tracking error. Tracking error measures how closely an ETF's performance matches its underlying index. A high tracking error indicates that the ETF's returns may deviate significantly from the index, which could affect your investment results. Liquidity of underlying assets. While ETFs themselves are highly liquid, the liquidity of the underlying assets can vary. Investing in ETFs with low trading volumes or those that track illiquid assets may result in wider bid-ask spreads and potential trading difficulties. Tax implications. ETFs are generally tax efficient due to their unique creation and redemption mechanism. However, investors should be aware of potential capital gains distributions and the tax treatment of dividend income. Building an ETF portfolio. Assessing your goals, determine your investment objectives, risk tolerance, and time horizon. This will help you select ETFs that align with your financial goals, whether you're looking for growth, income, or diversification. Researching ETFs. Evaluate ETFs based on factors such as expense ratios, performance history, tracking error, and the quality of the underlying assets. Use resources like fund fact sheets and comparison tools to make informed decisions. Monitoring and rebalancing. Regularly review your ETF holdings and make adjustments as needed to maintain your desired asset allocation. Rebalancing ensures that your portfolio remains aligned with your investment goals. Investing in ETFs offers a flexible and cost-effective way to diversify your portfolio and gain exposure to various asset classes. By understanding how ETFs work and considering their advantages and risks, you can make informed investment decisions and enhance your financial strategy. Investing in ETFs, while beneficial, comes with its own set of risks. Understanding these risks is crucial for making informed investment decisions and managing your portfolio effectively. Here's a detailed exploration of the potential risks associated with ETF investing and strategies to mitigate them. Market risk definition. Market risk refers to the possibility that the overall market or specific sectors within it may decline in value. ETFs, being market-traded assets, are subject to market fluctuations, and their prices can be influenced by broader economic and financial conditions. Mitigation. Diversification is key to managing market risk. By holding a variety of ETFs that track different asset classes, sectors, and geographic regions, you can reduce the impact of adverse movements in any single market segment. Tracking error definition. Tracking error measures the discrepancy between the performance of an ETF and its underlying index. A high tracking error indicates that the ETF's returns deviate significantly from the index it aims to replicate. Mitigation. When selecting ETFs, look for funds with a low tracking error. Review the fund's historical performance compared to its benchmark and assess the efficiency of the ETF's management in tracking the index. Liquidity risk definition. Liquidity risk involves the potential difficulty of buying or selling ETF shares without significantly affecting the price. Although ETFs are generally liquid, liquidity can vary based on the ETF's trading volume and the liquidity of its underlying assets. Mitigation. Choose ETFs with higher average daily trading volumes to ensure better liquidity. Additionally, consider the liquidity of the underlying securities to avoid potential issues with trading the ETF. Credit risk definition. Credit risk pertains to the possibility that the issuer of a bond ETF or the bonds within the ETF may default on their obligations. This risk is relevant for ETFs that invest in fixed income securities. Mitigation. Research the credit quality of the bonds held within a bond ETF. Consider ETFs that focus on high-quality, investment-grade bonds to reduce credit risk. Interest rate risk definition. Interest rate risk is the risk that changes in interest rates will negatively impact the value of bond ETFs. When interest rates rise, the value of existing bonds tends to fall, affecting the performance of bond ETFs. Mitigation: consider diversifying your bond ETF investments across different maturities and interest rate environments. Shorter duration bond ETFs are generally less sensitive to interest rate changes than longer duration bonds. Sector and geographic risk definition: ETFs that focus on specific sectors or geographic regions can be exposed to sector-specific or regional economic conditions. For example, a technology-focused ETF may suffer if the tech sector faces downturns. Mitigation: diversify your ETF investments across various sectors and regions to reduce the impact of negative performance in any single area. This approach helps spread risk and provides a buffer against sector-specific or geographic downturns. Management fees and expenses definition: ETFs have management fees and other expenses that can impact your overall returns. These fees are expressed as an expense ratio and can vary between ETFs. Mitigation: compare expense ratios when selecting ETFs and opt for those with lower fees. While low fees are important, also consider the quality of the fund's management and its performance relative to its benchmark. Regulatory and operational risks definition: regulatory and operational risks involve potential changes in regulations or operational issues within the ETF management company. These risks can affect the ETF's performance and stability. Mitigation: invest in ETFs managed by reputable firms with a track record of regulatory compliance and operational stability. Stay informed about changes in regulations that may impact your investments. Navigating the risks associated with ETF investing requires careful research and strategic planning. By understanding and addressing these risks, you can make informed decisions and build a resilient investment portfolio. Diversification, due diligence, and ongoing monitoring are essential for managing ETF investments effectively. To optimize the performance of your ETF investments and achieve your financial goals, employing effective strategies is essential. Here's a comprehensive guide to strategies for enhancing your returns with ETFs. 1. Diversification across asset classes objective: diversification helps spread risk by investing in a variety of asset classes, such as stocks, bonds, and commodities. This approach can reduce the impact of poor performance in any single asset class on your overall portfolio. Implementation: build a diversified ETF portfolio by selecting ETFs that cover different asset classes and investment styles. For example, you might include equity ETFs, bond ETFs, and commodity ETFs to balance your exposure across various types of assets. 2. Sector and thematic investing objective: sector and thematic investing focuses on specific areas of the economy or investment themes that are expected to perform well based on current trends or future forecasts. Implementation: identify sectors or themes with strong growth potential, such as technology, healthcare, or renewable energy. Choose ETFs that target these sectors or themes to capitalize on emerging trends. Be mindful of the risks associated with concentrated investments in specific areas. 3. Dollar cost averaging objective: dollar cost averaging involves regularly investing a fixed amount of money into an ETF, regardless of its price. This strategy reduces the impact of market volatility and helps average out the cost of your investments over time. Implementation: set up automatic contributions to your ETF investments at regular intervals, such as monthly or quarterly. This approach helps build your position gradually and takes advantage of market fluctuations. 4. Rebalancing your portfolio objective. Rebalancing ensures that your portfolio maintains its desired asset allocation and risk level. Over time, market movements can cause your portfolio to drift from its original allocation, potentially increasing risk. Implementation. Periodically review your ETF holdings and compare them to your target allocation. Adjust your investments by buying or selling ETFs to realign your portfolio with your strategic goals. Rebalance on a regular schedule, such as annually or semi-annually. 5. Leveraging tax efficiency objective. ETFs are generally tax efficient due to their structure, but there are additional strategies to enhance tax efficiency and minimize tax liabilities. Implementation. Utilize tax-advantaged accounts, such as IRAs or 401(k)s, to hold your ETFs. Consider the tax implications of capital gains distributions and manage your investment activities to optimize tax outcomes. Tax loss harvesting, which involves selling losing positions to offset gains, can also be beneficial. 6. Using limit orders objective. Limit orders help manage the price at which you buy or sell ETF shares, ensuring that you execute trades at desired price levels and avoid overpaying or selling at too low a price. Implementation. When placing trades, use limit orders rather than market orders. Set your buy or sell price to match your investment strategy and avoid impulsive decisions based on market fluctuations. 7. Monitoring performance and adjusting strategies objective. Regularly monitoring your ETF investments allows you to assess performance, stay informed about market conditions, and adjust strategies as needed to stay aligned with your goals. Implementation. Track the performance of your ETFs against their benchmarks and review any changes in the underlying assets or market conditions. Make adjustments to your ETF selection and strategy based on performance analysis and changing investment objectives. 8. Exploring niche and alternative ETFs objective. Niche and alternative ETFs provide access to specialized areas of the market that may offer unique investment opportunities. Implementation. Research niche ETFs that focus on emerging markets, innovative technologies, or specific sectors with growth potential. Be aware of the risks associated with less liquid or more volatile segments of the market. 9. Combining ETFs with other investment vehicles objective. Combining ETFs with other investment vehicles, such as individual stocks, bonds, or real estate, can create a well-rounded investment strategy. Implementation. Integrate ETFs into a broader investment portfolio that includes various asset types and investment strategies. Use ETFs to gain broad market exposure, while incorporating other investments, to achieve specific financial goals. Maximizing your returns with ETFs involves employing strategic approaches and maintaining an informed, proactive investment approach. Diversification, regular monitoring, and strategic adjustments can enhance your investment outcomes and help you achieve your financial objectives. How to select the right ETFs for your investment goals. Choosing the right ETFs is crucial to aligning your investments with your financial objectives and risk tolerance. Here's a detailed guide to help you select ETFs that best meet your investment needs. 1. Define your investment goals objective. Clearly identifying your investment goals helps narrow down your ETF choices to those that align with your financial aspirations and risk tolerance. Implementation. Determine whether you are seeking growth, income, or a balance of both. Consider your time horizon, such as short-term versus long-term goals, and assess your risk tolerance. For example, aggressive growth investors might focus on high-growth equity ETFs, while income-focused investors might prefer dividend-paying ETFs. 2. Understand the ETF's investment strategy objective. Different ETFs follow various investment strategies, such as tracking an index, focusing on a specific sector, or investing in thematic trends. Implementation: research the ETF's strategy to ensure it matches your investment preferences. Look at the fund's prospectus to understand its investment approach, including the types of assets it holds and its target benchmark. Ensure that the ETF's strategy aligns with your investment goals and risk tolerance. 3. Evaluate the ETF's performance objective. Analyzing an ETF's historical performance provides insights into how well it has tracked its benchmark and how it has performed relative to other similar ETFs. Implementation: review the ETF's performance over various time periods, for example, 1 year, 3 year, 5 year, to gauge its consistency and track record. Compare its performance to its benchmark index and other ETFs with similar strategies. Keep in mind that past performance is not indicative of future results, but it can provide valuable context. 4. Assess the expense ratio objective. The expense ratio represents the annual fees charged by the ETF as a percentage of its average assets under management. Lower expense ratios generally mean more of your returns stay with you. Implementation: compare the expense ratios of different ETFs in the same category. While lower fees are desirable, also consider the overall value provided by the ETF in terms of its strategy, management quality, and performance. Avoid focusing solely on fees at the expense of other important factors. 5. Examine the ETF's liquidity objective. Liquidity affects how easily you can buy or sell ETF shares without significantly impacting the price. Higher liquidity typically results in narrower bid-ask spreads and easier trading. Implementation: check the average daily trading volume and the bid-ask spread of the ETF. ETFs with higher trading volumes generally offer better liquidity. Additionally, consider the liquidity of the ETF's underlying assets to ensure smooth trading. 6. Review the ETF's holdings and sector exposure objective. Understanding the ETF's holdings and sector exposure helps you assess how well it fits into your overall portfolio, and whether it provides the desired diversification. Implementation: examine the ETF's top holdings and sector allocations to ensure they align with your investment strategy. For example, if you want exposure to technology, review the ETF's technology holdings and assess its weight in the tech sector compared to other sectors. 7. Consider the fund's issuer and management team objective. The reputation and expertise of the fund issuer and management team can influence the ETF's quality and performance. Implementation: research the ETF issuer's track record, reputation, and experience in managing ETFs. Look for well-established issuers with a history of successful fund management. Review the fund's management team's qualifications and their experience in managing similar funds. 8. Analyze the tax efficiency objective. ETFs are generally tax efficient due to their structure, but understanding the tax implications can help optimize your investment outcomes. Implementation: consider the ETF's tax efficiency, including its potential for capital gains distributions. Utilize tax-advantaged accounts, such as IRAs or 401ks, to hold your ETFs and reduce the impact of taxes on your returns. 9. Read the ETF's prospectus objective. The prospectus provides detailed information about the ETF's objectives, strategy, holdings, and risks. Implementation: carefully read the ETF's prospectus before investing. Pay attention to sections on investment objectives, risks, performance history, and fees. This document is essential for understanding how the ETF operates and what to expect from your investment. Selecting the right ETFs involves a thorough evaluation of various factors, including your investment goals, the ETF's strategy, performance, fees, and liquidity. By following these guidelines, you can make informed decisions and build a well-rounded ETF portfolio that aligns with your financial objectives. If you found this guide on selecting ETFs helpful, don't forget to subscribe to the channel and like this video for more expert tips and investment advice.